Yeah, thanks for having me on, Kelly. Well, it's really not that complicated. It's really basic macroeconomics. When you have inflation that's significantly higher than target, you need to move to address that inflation. And that means moving the nominal policy rate maybe close to the rate of inflation, which is currently at 6%. So the idea that the Fed would move 50 basis points 4 times, that's only 200 basis points of rate rise. It's really not that aggressive given the inflationary environment.
It's certainly not. And in fact, Goldman, which has also been on the more hawkish side of these calls, is out there saying for the Fed to get wages down to something sustainable with their funds rate goals, they need to hike 75 basis points more than what's already priced in. So a little bit closer to your forecast. So I guess the main question right now is why not? And what do you think they're doing with all this talk about the balance sheet?
Yes, I think there are a few things going on. One is the Fed is still trying to obtain a soft landing, and a soft landing is still possible. It just becomes a lot harder when inflation is running this high. So can they cool the economy down without taking the economy into recession? They may be able to do that, and they're trying to kind of carefully calibrate the policy right now to get that policy rate mix correct. So part of that is raising policy rates, moving interest rates higher, and that's what the market is pricing in. But part of what Governor Brainerd is talking about today and what we'll see in the minutes on Wednesday is what are they going to do with the balance sheet? That's the other lever they can pull on to try to create higher rates in the back end, higher mortgage rates, and try to put some restraint on the economy to bring down inflation.
You've kind of got a forecast, meaning 4 rate hike projections for later this year. Are you in the least bit surprised, Andrew, that the stock market hasn't reacted more harshly than it has to all of the discussions, including yours, of higher interest rates and now a more aggressive tapering of the balance sheet?
There does seem to be a little bit of a disconnect where fixed income markets, interest rate markets seem to be pretty much digesting what the Fed is telling us, pricing that in various forms. Like Rick Santelli was talking about, we have a lot of rate hikes that are priced in now. And meanwhile, the equity market continues to show relatively lofty valuations. And I would just take Chair Powell very seriously when he says that his intention is to tighten financial conditions. Tighter financial conditions means higher interest rates, but it may also mean lower valuations for risk assets.
All right. Andrew, thank you very much. We appreciate your time today. Andrew Hollenhorst.